When we look at bond returns, we aren't just looking at a single number. We can actually decompose that return into three distinct ingredients. First, we have the forward rate, or F of t. This represents your baseline yield, what you earn simply because time passes, assuming interest rates stay exactly where they are. Next, we account for the impact of interest rate changes. Because bond prices move inversely to rates, we subtract the product of duration and the change in rates, minus d times delta r. If rates go up, your return goes down. If rates go up, your return goes down. Finally, we add the volatility and convexity component, plus 1/2 times c times sigma squared. This is a convexity bonus. Because of the mathematical shape of a bond's price yield curve, high volatility actually boosts your total return, regardless of which way the market moves. Now, how much return you expect to get depends on your appetite for risk. A risk-neutral investor is happy with just the short-term risk-free rate, or R0. They don't need an extra incentive to deal with market swings. However, most people are risk-averse. They demand a risk premium, represented by lambda, for every unit of duration risk they take on. To find their expected return, we use the formula E of return equals R0 plus open parenthesis lambda times D close parenthesis. For example, if the risk-free rate is 3.0% and you have a bond with a duration of 5 and a risk premium of 20 basis points, a risk-neutral person expects 3.0%, but a risk-averse person expects 4.0% to make the investment worth their while. We can take this a step further by looking under the hood of the forward rate itself. The forward rate is essentially built from three things: expectations, risk, and convexity. The formula is F of t equals open bracket R0 plus D times E open parenthesis delta R close parenthesis close bracket plus open parenthesis lambda times D close parenthesis minus open parenthesis 1/2 times C times sigma squared close parenthesis. The first part is what the market expects to happen to rates. The second part is the risk premium we just discussed. But notice the last part. We actually subtract the convexity effect here. Why? Because convexity is such a benefit to the investor that the market prices it in, leading to a slightly lower starting forward rate. It's like paying a small entry fee for a bond that performs better in volatile times. Let's put it all together with a final calculation. Imagine a bond with a 3.0% short-term rate and a duration of 5. If the market expects rates to rise by 0.4%, we factor that in. We then add our risk premium of 20 basis points per unit of duration. Finally, we subtract a convexity effect of 0.50%. When we run the numbers, 3.0% plus 5 times 0.4% plus 5 times 0.20% minus 0.50%, we get a forward rate of 5.5%. This single percentage tells the whole story of the bond's environment, from the passage of time and market expectations to the specialized math of convexity.